So, welcome to this quantitative finance, almost the last fag end of few lectures. So, as we are discussing about the gaps are basically either static or dynamic. Static means that they are not dependent on time, dynamic they are dependent on time. So, if you see the graphs which we just discussed, the difference between the asset and liabilities would give you how the balancing of the inflow and outflow can be done. So, type of gaps are simple gaps, cumulatives or of simple gaps that you find out the overall gap and then you find out whether it is positive or negative, and the marginal gaps are the rate of change of the gaps with respect to time. So, you can also understand is basically a cyclicity is there. If there is some seasonal, like if you remember, we did, even though that may not be related to ALM, we did the different type of trend analysis, seasonality and all these things. So, if they can be brought in the picture, you can also find out how the gaps change with respect to time, and you can also find out the cumulative of the marginal gaps. Cumulative of the marginal gaps would be in some way give you the rate of change or the marginal rates, that should also give you some information on the d2y dx2, which is the second derivative. So, it is important to note that for a fixed rate there will not be any interest rate risk. If the interest rate is floating, then the problem of the balancing assets with respect to the interest rate risk basically comes into the picture. So, if I want to find out the marginal differences or if you want to find the interest rate fluctuations, then obviously it is given by the gap is given and the rate. So, the gap is given multiplied by the difference in the interest rate. So, that will give you the total interest margin based on which you have to basically face the problem, or it may be the asset also depending on the ALM model you are doing. Now, you can find out the rate of change on the interest rate margin, that will give you how the interest rate is changing. So, if you have say for example, IM 0, which is or the interest rate margin or difference at time t is equal to 0, you can find a del IM, which is the rate of change, and similarly you can find out del IM 1, which will be a summation of both these things. So, as you proceed, you can find out the weights. Then if you want to find out say for example, the expected value variance, because expected value and variance will give you a lot of information on how it is the work is done. So, that will also help you in trying to analyze the overall asset liability concepts based on expected value of rate of change of IM, interest margin, expected value of rate of the change of the IM at any particular point of time. Similarly, you can find out the standard deviation for the first one and standard deviation of the second one. To find the successive values of interest margin, we use the recursive methods. That means, we go one step forward or backward depending on what is the overall significance, how many states depend. So, if interest rate is dependent on the 2 states backward, so obviously it will be dependent on 2 state process. So, we would not be going into details, but what I am trying to explain is that how they can be done. So, given IM 0, which you have just discussed, we proceed to find IM 1. That means, only the first information is needed. That means, if you have reached IM 1, you will find out only set of information needed is IM 0. But say for example, if you reached IM 1, that means you are trying to find out the interest rate margin and you think that is dependent on function of 2 states, IM 0 and IM minus 1. So, obviously, it will be a 2 stage dependence. But there are caveats, warnings, always try to make the difference between the time periods as small as possible, because if you remember again, we have said the volatility or external noise is dependent on variance, is dependent on time t, or standard deviation is a function of square root of t. So, that means, as you increase the time difference, hence the volatility increases. So, try to predict for a small time frame horizon, this will minimize the errors. Per se, these values may be important, but what we may be interested is to compare the predicted values with the actual values. So, the historical values of volatility of interest rates are available from historical time series. Consuming a yearly volatility of 1.5 percentage based on whatever you have done, using normal distribution, we can define a confidence interval for interest margin, and also you can find out what is the probability of a company being default or not being default. Hence, with the gap of 2000, we have the yearly volatility given by 2000 into 1.5 percentage, whatever you calculate. So, you can find out the expected value. So, expected value would be given. So, what you are doing is that you have IM 0, and here you have the ratios. So, the ratios are basically the expected value of the interest rate divided by the standard deviation, and then you basically multiply it by the ratio, which is this. So, what you are interested is to find out what is the ratio of the interest rate margin with respect to the interest rate change. So, both are differences, that will give you a lot of good information, because interest rate margin is dependent on many functions, where its effect is being given on the picture of interest margin. So, if you look at interest margin only, it has many functions, amongst which interest rate is the most important factor. So, very technically, very simple, IM is equal to the rate of change of or delta of R into the gap. So, gap is fixed, it only depends on interest rate. If gap is not fixed, it is a function of dependence between two factors or more. So, if there are more than one interest rate, you can basically find out by the simple summation, but the problem is this is a random variable, this is a random variable, that is interest rate 1 is basically also dependent on interest rate 2 or vice versa. So, these are random variables, means you will have covariances. So, if you have the covariances, then you need to find out what is the variance covariance matrix, but in general finding out the variance covariance matrix for an interest rate or such variables becomes difficult for us. So, what you need to do is that you basically have to express interest rate 1 or interest rate 2 in functional forms of the other interest rate. So, if you have 3 interest rates, you will try to basically express 2 of them as functions of the first, and then try to solve your problem accordingly, rather than basically going into the covariance variance matrix. So, different performance measure used for calculating or utilizing the assets liabilities are returns of assets, return of equity, mark to market concept. Mark to market concept is almost the same thing which we had done for the options, that in the chapter on options we have basically had a market and the future and forwards were being sold and bought. So, in order to basically reduce the overall risk, we had a margin account. So, margin account, the values which were changing as the prices change, the margin account values also changes. So, you have the initial margin, mark to market concept was used there also. Mark to market is exactly the same thing, that means you change your overall risk, and the input and output in that account is made in whatever account you are considering, whether it is a buyer or a seller or a person going a long and a short position. That depends on how the price fluctuations are happening in the market, and how those price fluctuations are affecting the margin account, and how amount of money is being either input or taken out in order to basically make it exactly according to what is the state of affairs as of now. We also have the risk adjusted return on capital. So, the return on the capital is also considered, considering the different type of interest rate and how they are adjusted accordingly. You also have the concept of value of risk. So, we will lay more stress on the value of risk in 1 or 2 lectures coming soon. So, other important factors are returns of assets, which is basically incomes to assets, return to equity, income to equity. These concepts are very heavily used in asset liability management. Here the mark to market concept with risk adjusted return to capital. This measure was introduced by Bankers Trust in the late 1970s and the early 1980s. Risk adjusted return on capital allocates a capital charge to a transaction or amount equal to the maximum expected loss you can face. So, now the concept of maximum loss which you can face, which has some implication with the VAR concept also, would be discussed soon. The basic steps in the process of how to find out the RA, ROC are analyze the activity or product and determine the basic risk categories, quantify the risk in each category by a market proxy, that is a value which you can measure. So, measure can be interest rate, can be risk free interest rate, can be say for example currency, can be dollar to yen, can be dollar to rupees, whatever it is, it can be the price index. So, all these things can be considered, where they give you the actual picture how things are happening. It can be the share price also, it can be say for example in the profit and loss account, say for example the total amount of dividend which is being given. So, or what is the total concept of liability, or what is the total amount of or working capital, or what is the total amount of say for example long term loans. So, all these things can be considered on an individual or a collective basis to find out how the asset liabilities overall structure is being done, considering the RA, ROC concepts. So, he is using historical price movement on the market proxy over the last 3 years, compute a market risk factor given by the following example. So, RA, ROC would be calculated this 2.33 into weekly volatility, and this 52.5 means, because this is the number of weeks. So, 52 is the weeks. So, and if you remember, volatility or standard deviation is proportional to square root of time. Hence, this square root of time is coming, that is 52 to the power half, and this weekly factor and this 2.33 but technically would mean that it would take you plus and minus, if you remember the standard the deviation and the concept of the normal distribution. So, you have the normal distribution is the mean. So, if you move 1.67 onto the right and left, or 1.9 or 2.3 onto the right and left, you will basically be covering 2 sigma or 4 sigma or 6 sigma of the overall spread. So, 2.33 is depending on the level of confidence you want to put. Then obviously, you multiply by the 1 minus the tax rate, because the tax amount has to be taken out of this total concept. So, if the tax rate is say for example 30%, it will be 1 minus tax rate would be 0.7. So, in this equation the multiply 2.33 gives the volatility expressed as a percentage at a 99% confidence level. So, that is what I mean. If you consider 99%, so overall standard deviation movement in the normal distribution would be 3 sigma onto the right and 3 sigma onto the left. So, obviously, the total coverage would be 6 sigma. An important thing to remember is the number 2.33 means that there is 1% probability. That means 99% means 1% onto the left and right. So, if you consider a symmetric distribution and the normal distribution, then the overall area onto the right and the left total they add up to 1%. So, if they are symmetric, it will be equally distributed. That means 0.5% on the right, 0.5% on the left. So, 2.33 means that there is 1% probability that a normal distributed variable will decrease by more than 2.33 standard deviation. Compute the monetary value of the capital required, find the ROI ROC by dividing with the profit, which is planned or expected, whatever it is, and then you find it out. So, you repeat the steps and you can find out the ROI. Using the concept of ROI ROC, you can find out the ROI ROC value and then find out the risk adjusted overall concept for the ALM model. Consider the following example where a government trader, a person trading only in government treasuries, requires a nominal capital allocation of 14 million and foreign currency trader requires about 6 million. If both of them make the same profit, say 2 million, then very simply calculated the government trader would have a profit percentage of 14.3 and the foreign currency of 33.13. But what is the actual profit percentage if you use the concept using the interest rate and actual risk adjusted concepts? So, the government trader, suppose 5% per annum is the interest rate and the tax rate is 8%, and while the foreign currency assume 18% per annum and the tax rate is 10%, then if you calculate you will find out it is 12.9 for the government and 24.2 for the foreign. So, note that if you will be comparing 14.3 with respect to 12.9, so the increase which is happening, this one with this one decrease or increase, and if you consider this one with this one, there you will find there is a lot of difference, even though the values would be different with if you compare the foreign trader with the government one, but still the increase and decrease is happening at a much more pronounced level, considering that you are considering the risk adjusted concepts, you are considering the interest rate and all the concept of ROC. So, return on risk adjusted assets is similar to ROA, but denominator is adjusted according to the varying riskness of the asset class. So, if they are asset class which are very risky, less risky, you will basically multiply by a factor accordingly. So, remember for studying the risk, you always try to concentrate on the losses rather than the gain. So, now you are concentrated for the ALM is that try to concentrate on the loss, try to minimize that. So, what your actual concept of formulation would be very subjectively would be minimize some unexpected loss such that the portfolio weights is equal to 1. This is the same thing, if you remember in the initial classes we have done. Expected loss which is multiplied by the expected incomes and expected losses should be greater than the target return. So, whatever the target return is, your difference in the incomes and outflows should basically be more. And total assets should be, if you want to find out the ratios. So, if it is basically return on assets, so if you take the return on assets on this left hand side and known income divided by the total assets, that will give you a ratio. So, the return on assets should be, what is the projected one? Whatever you are putting, you will try to basically beat that, but it means make it more. Doing post optimal analysis is helpful in identifying the factors and the margin costs that constrain the institution from reaching goals superior to those indicated by the optimum results. So, there are different type this in evaluating the credit risk, the ultimate measure is the risk of the entire portfolio. So, in order to do that you have to basically diversify in order to find out the minimum risk. Our main aim is to in portfolio management is not to determine the overall risk alone, but to determine the collectively what is the maximum return and what is the maximum risk level you are going to basically be able to withstand. Obviously, returns are good, but commensurate to that risk is also there. So, you always try to analyze what is the overall level of risk you will be able to sustain. Three key points emerge from portfolio analysis from the ALM point of view. These are the amount of diversification achievable in a portfolio depends on the correlation between default risk. Now, if you remember, I mentioned just few minutes back, finding out the correlation coefficient between interest rate becomes difficult. So, if you find out different type of default risk, trying to find out the correlation coefficient, covariance matrix between them becomes very difficult, because you do not have the data, you do not know the structural equation dependence between them. The amount of risk contributed by an asset to the portfolio net diversification depends significantly on how much of the asset is held in the portfolio, which will also change dynamically. And improving portfolio performance consists of including large numbers of assets and varying asset holding to bring each asset to the portfolio would basically mean you have to dynamically change. So, the first and the second and the third point are related. So, if they are dynamically changing, point 1 WIs are changing. Point 2, the covariance matrix also would change, because as you change the weights depending on what are the variables are also dynamic dependent on time. If they also change, the correlation coefficient also changes. So, rather than concentrating only on fixed value, you have to recalculate at each and every step in order to find out the covariance matrix or the correlation coefficient. So, Altman, if you remember Altman, who had given that Z score and all these things. So, Altman portfolio approach is simply the same thing which you have done, find out the ratio of the maximum of the return to the risk. So, what you are trying to do, you are trying to find out the ratios of output input which is coming divided by the output and try to maximize and rank them accordingly. So, again the same thing, you want your weights to be 1 and you want your total portfolio to be returns to be greater than some R star value, and again you can use the simple methods we have considered accordingly. Alternative would be reverse the objective function. In the objective function, you can basically now find out the minimization of the risk to the return. So, this one is just a ratio, inverse ratio of the first one we have just discussed. So, this remains same, this is the same thing, and this is being brought into the picture. So, in order to basically have two different constraints, one is respect to the return, one is respect to the risk. Another thing can be, if you consider Morgan and Gollinger's model, there you consider again it is basically concept of minimizing the risk, only risk, not the ratios. Weights are 1 and the returns of the portfolio is greater than some R star. So, whatever you see this two different models of Altman or different Morgan and Gollinger, their conceptual wise are exactly the same thing which you have done. So, you have only technically two matrices or metric. One is basically the return and one is the risk. Find out maximum return, solve your problem depending on different constraints, or minimize your risk depending on different constant, or try to find out the ratios. So, if it is return to risk, you rank them from maximum to minimum, take the maximum. It is risk to return, rank them from minimum to maximum, take the minimum. So, obviously, the conceptual framework is this, but the solving the techniques are all the Lagrangian and the ranking or whatever you have done. And if you remember the ratios concept, this one we have already done, this one we have already done. So, all these things are just a repetition trying to analyze the problem in the ALM concept. Alternative formulation would be same risk, same thing constraints, but now you basically become two. Either you can consider this or you consider this, or you can consider both of them together, but if you consider both of them together, then obviously the problem solution may be difficult, but it will give you much more compact results. For any portfolio, we can use the concept of unexpected loss. So, unexpected loss is basically the excess deviation over the standard deviation. So, this value, which is the variance, if it is greater than some star value of sigma square of the portfolio, which is you already fixed, and your variance of the portfolio is coming out to be more than that in value terms, then obviously that gap is the overall extra risk or unexpected loss you are going to face. Logically, we will always try to make it minimum as possible, if not 0. 0 is best, and if you basically are going on the other direction, making the loss or the risk less than the stipulated value, it is very well, and that is wanted. But your main concern, if you remember, I said that we always try to analyze the risk perspective. So, you are always concentrating on excess risk and try to minimize it or make it 0. Generally in ALM we use two variables, one is interest income, one is net present values of asset minus liabilities, which is the gap. So, you want to find out the net present value. The main difference between interest income and NPV with net present values is NPV captures the entire stream of futures cash flows, both positive and negative, while for interest income we are mainly interested in calculating inflows rather than the outflows. So, we should always consider the fact of the inflows and outflows. So, the building blocks are risk drivers, risk exposure, standalone risk, correlations, portfolio risk and capital. So, I will continue discussing this, and with this I will close today's class. In the next class I will again discuss this slide and go into the details, and then go into the concept of variance, value at risk, conditional value at risk, and consider all these things later on. Thank you.